After a great lunch, I want to ask a very tricky question to you all. Is auditing a science or is it an art?
Both.
I think neither. It's like making a biryani. If you follow the right steps and you have the right ingredients, you end up with something delicious. And if you don't, you may end up with a khichdi instead. So, on that note, my name is Sharma and my paper presentation is on case studies on standards on auditing. Before we dive into any case studies, I'd like to ask you another question. What is audit quality to you? Is it just about ticking the check boxes, making sure the balance sheet is tallied? Or is it just something else? Well, in my opinion, it is leveraging on the global best practices to enhance the assurance that we give to the users of financial statements and mandated by ICI for members in practice. With increasing oversight and regulations like NFRA and external stakeholders' expectations, it is important that the practitioners follow these standards religiously. So these case studies will help you understand how standards are applied in real practice. So before we move forward, I'd like to give you a quick recap of the audit process. The audit process has 5 phases. The first phase is acceptance and continuance. The second phase is planning and risk assessment. The third step is performing the actual audit procedures. Then your manager would go for the review procedures. And lastly, you go on to report. But since auditing is continuous in nature, you go back to acceptance and continuance. So I'll focus on 3 key steps. First, planning and risk assessment. The second, review and completion. And lastly, reporting. So let's jump into the first case study. We are auditing a company, IT trends company, which is going into liquidation. Well, it will be a messy audit. Let's see. In January, the technology and equipment to a large MNC player. Of course, a good buyout. And the operations will be shut down by the end of February. All of the staff of operations, HR, sales would be laid off. This will cause a lot of redundancy in the organization. But only key staff from finance and accounting will remain when we sign off the audit report. There are some properties that they are going to go for sale in the next year. These will be held for sale. These should be classified appropriately. And there are some leases which cannot be sublet or even cancelled. So these will become onerous leases. All this needs to be taken care of. Now, it becomes a very messy audit. And how do you navigate through this? This is where Standard on Auditing 315 comes into play. It introduces an idea of risk-based auditing, where you identify audit risks and evaluate them based on 2 parameters. The first one, the likelihood of the impact, and second one, the magnitude of the impact. The likelihood is only because of its inherent risk, the possibility of it occurring, and the magnitude is considered after any controls, that is taking care of the control risk as well. In this way, we are able to identify significant audit risk areas which are required to be addressed by the engagement partner. These should be signed off so that you meet the audit quality requirements. And these significant audit matters are in the later in the reporting segment. So, but how do we do this in real practice? You would require a matrix approach. What we will do is make a matrix where you will plot the significant class of transactions, account balances and disclosure in a column, and thereby identify what are the related risks to that class of transaction or account balance. So let's take an example. If I say there is a redundancy provision due to the layoffs, that redundancy provision has a risk that it might be understated or overstated. Amount may be misstated. But the control related to such provision is that the legal department would determine it. So a certain level of expertise acts as a control and mitigates the difference. And now we'll add a likelihood of the impact and the magnitude of the impact based on our experience with the client and its financial statements. And then we'll have a product of the 2 as a risk measure. This risk measure will help us to evaluate risk in relation to the other class of transactions. And if you are auditing a very large unit of an organization, or maybe you are a group auditor, these risks will come to around 100 or 1,000 numbers, then how will an engagement partner identify which one is the significant risk? So we as articles can help our partners identify this by graphical way. You can see the graph, the circles are relative to the size of the relative risk measure. And you can clearly see that the biggest circle is the inventory one, which is clear that inventory needs to be addressed at the first liquidation. So, concluding on IT trends, at the planning stage, you need to also consider, can you apply the substantive analytical procedures as set by SA 520? So, for the first 10 months, you can apply because the plant was operational, there were regular operations going on, you can do that. But in the last 2 months where you decided to sell off, I don't think that is a fair procedure. What about written representations? Because most of the staff would be laid off, and SA 580 requires that the person accountable to do the work in the financial statement should sign off their responsibilities as an MRM. But most of the staff would be laid off. You would not be having your HR manager signing off your payroll papers. So you need to have the idea of an early representation. Moving on. Now we become the managers. Now we are going to review the work papers of the articles. How about it? So this is a snapshot of motility calculation as per SA 320. Motility is calculated on a benchmark, and we have chosen profit before taxes. Now, the articles have audited revenue area. They've selected a sample of ₹1 million and they've identified misstatements of only 8,000. Good, it seems nice. But we as managers receive this and now we have to project these misstatements. We have applied sampling at this stage of substantive procedures. Now we need to project these misstatements. We have only audited the sample, but we need to give the opinion about the whole population. We do this by taking the ratio of the identified misstatements and the sample tested and multiplied by the population amount. We end up with an amount of 64,000. What do we do about this? We'll compare this amount with the performance materiality. We compare the projected misstatements with performance materiality to determine whether we need to do more sample testing or not. And in this case, the projected misstatements exceed the performance materiality. You can tell the articles, go back, get some more samples, and then we are ready to go. If I add some more context to this scenario, there is a summary of uncorrected misstatement file that is required to be maintained as per SA 450. In this work paper, what do? Is whatever is the identified misstatements, we make a summary of it, and so that we can tell the management at the end, you need to correct these transactions. So in our summary of uncorrected misstatement file, we have 2 entries. First one is an undervaluation of the expected credit loss, and there is some non-accounting of TDS interest and penalty. So individually, these transactions were not material. They were below performance materiality, but they were above clearly trivial thresholds. CTT, the clearly trivial thresholds, are the amount, a threshold below which we ignore anything in audit, where you can clearly say immaterial hai, jane de. To correct them, or rather give them a chance. Bro, please correct, else we'll have to modify. And if they don't correct it, you go to the directors, you tell those charged with governance, please check with the management why they are not correcting these things. And if you don't correct them, there would be an expected form of modification in the report. This is also important that professional skepticism should be applied here. Because if the management is not considering to change the entries in the financials, then there might be some problem with their integrity. Concluding on reviewing the files, first, you need to communicate the identified misstatements to the management, and for that you need to maintain the summary of uncorrected misstatement file. Second, it is a very standard process to obtain written representation from the management at the end of the audit that all identified and uncorrected misstatements are considered to be immaterial in their opinion. This is so that the auditor is safeguarded against any further scrutiny. But why are we not communicating the projected misstatements? Because the articles were told that there is some projected misstatement in the file. There is some 64,000 of projected misstatements. Why don't we tell the management that you need to correct these? Because these are not identified yet. You cannot tell the management, go find out these invoices which I don't know. So avoid these mistakes. Case study 3. It is about a group audit. I think you'll like it. It is about a group entity which holds a foreign associate underneath it. So the structure is as follows. The first, the P Holding Limited has a wholly owned subsidiary S Private Limited, and it has an investment or a significant influence over T LLC, which is situated in Europe. Now, by the end of the audit, the management has told us that they were unable to get the audited financial statements of T LLC. But the management is not just honest to the auditors, but also to the members. So they have decided to disclose this in their financial statements, that they were unable to get the audited financial statements of T LLC, and therefore they were unable to apply the equity method of accounting as per Ind AS 28. What do you think? This amount was determined to be material, and this is a clear disclosure. A material thing, but a clear disclosure. Do you think an EOM paragraph is necessary here, or a qualified opinion is necessary here? If you think an EOM paragraph would work, I'll pursue you into a qualified opinion. First, we'll get an idea of what is a misstatement. A misstatement is a deviation from what was required by the framework and what was reported by the entity. The requirement of the framework was that equity method of accounting is adopted, but the entity has adopted cost method. Well, if you don't believe me, I'll quote Ind AS 1 now. There is in no way an inappropriate accounting policy can be adopted by either way of disclosure in the notes to financials. Simply put, your honesty cannot protect you from wrong policies. So this is a clear case of material misstatement. A qualified opinion is necessary with the wordings of except for possible effects. If you adopt an EOM paragraph is not a substitute for qualified opinions or modified opinions. This would amount to a non-compliance with the standards on auditing, and therefore failure to reach audit quality. This was a case held by NAFRA as well. Before I conclude, I'll share just one critique of the standards on auditing. They do not apply the scalability aspect. The scalability aspect is not dealt within the standards on auditing really well. These are applicable to larger and complex entities. They fit well for them, but not for lesser complex entities. The international auditing standards deal with it better, but the Indian standards fail to do so. So, as my conclusion, in God we trust, the rest we all audit.